Well, I guess what I would say if I start from portfolio theory is looking out over the last decade, the return on the S&P is 11.6% for 10 years running as of today. The return on NASDAQ 17%. The return on Bitcoin is 200% annual. The return on gold is less than 2%, and the return on long bonds like TLT 4.2%. So my first principle is the cost of capital surrogate. The closest one is really the return of the S&P, which is 11.6%. It turns out that another version of the cost of capital is the rate at which the M2 money supply expands, which is pretty close to that, maybe 11% over that time. Before March of 2020, that was like 8%. And then we had about 24% expansion in the last 12 months. And so all of these cost of capital numbers get out of whack in the last 12 months. But if I'm going to invest, my first issue is, can you beat the cost of capital 11.6%? Okay, because I could basically get 11.6% by buying SPY in the next 30 seconds and do it with a low fee fund. So I don't really think I agree with you, managing 300 different names, not likely. You're just creating another index. Doesn't make sense. So what do I really think? Here's what I really think. I think that if you look at the past 12 months, the S&P is up 39%, Bitcoin's up 582%, NASDAQ's up 57%, gold is up 2%, and long bonds are down 16%. So what do I think? I think that if your returns are less than the S&P 500 index, you're destroying wealth. You're diluting your wealth. Everything you invest in that can't return the S&P 500 is a wealth dilution. And I think if your returns are less than Bitcoin, you're diluting your opportunity. You could have got 200% per year before tax, tax deferred for a decade in Bitcoin. So if you're taking risk or doing something that's really different, are you going to get 200%? Because Bitcoin is an index against the cyber economy. S&P 500 is an index against the entire economy. I would just tend to be skeptical of any hedge manager. Like I probably wouldn't give most of them any of my money, because to tell you the truth, the single best screaming home run right now is to buy as much Bitcoin as you have risk tolerance if you want to get an outsized return, and then take the rest and just dump it in the S&P 500 and wait. Bonds are going to be a disaster because the cost of capital is now 39%. And the M2 money supply is 24%, 25%. So somewhere between 25 and 39%. I think the 39 is because the jerking around the S&P about a year ago, but let's even say 25%. So you got to get better than 25% if you're going to avoid being debased by the currency expansion. And you can't do that with a bond that yields 2% interest or 4% interest. So bonds don't work. Commercial real estate doesn't work because no commercial real estate has a rent yield of 25%. They're all capped at CPI, and they've got like a cap, they've got like a 3%, 4% yield. They trade like long bonds. So now you're into equity. And my answer is I wouldn't bother with equity, because for the most part, show me if the money supply is expanding at 25%, show me companies that are going to grow their cash flows 25% a year for the next 8 years. Not many, not many, right? I mean, so, I guess if you'd asked me that question a year ago, when the cost of capital was 8%, right? The money supply is expanding at 6.5 or 6%, and the S&P is doing 8.5% for a decade. If you'd asked me that question, I would have said, okay, well, find some money manager that's got a specialty that can beat 8%. And if you believe that, then yeah, put your money with them. Otherwise, put it in the S&P. And, big tech, that's an example. Big tech was beating the S&P, and Apple, Amazon, Facebook, Google, that all made sense. But I think if you ask me that question now, today, thinking from first principles, I have to say the Federal Reserve and the EU Central Bank have tripled the cost of capital. And that's made your investment decision much easier. What they've done is they put 95% of every company underwater. Most companies can't grow their cash flows 25% a year. It's literally impossible to do without taking on insane risk. And so why is Tesla working? Because people are looking for hyper growth that they think is not going to be, that's going to grow more than 25%. It's going to change the world. And if I don't like that, I go buy GameStop, and otherwise, what are you going to buy? Big tech? You can buy big tech, but they're all tech monopolies. Will Facebook, Apple, Amazon, and Google going to be able to, can they raise their prices 25% a year for every year for the next 8 years without regulators doing something about that? Maybe. That's your bet. Otherwise, Angela, I guess the real issue is, I would say, the fundamental, most important question every investor has today is, you take a spreadsheet and you write the years 2021, 22, 23, 24, 25, 26, 27, 28, 29 on it. And then you put in the percentage increase in the money supply that you expect the Fed or the EU central bank to print, and really just the Fed. And if you put in a number 0.00000, you're an optimist, right? And then you've got 1,000 complicated choices. But if you put in a number of 15, 15, 15, 15, 15, you can't buy bonds, you can't buy real estate, you can't buy 95% of the stocks. And if you put in a number 20, 20, 20, if you think that the currency is going to weaken by 20%, all you can do is buy scarce assets, trophy assets, scarce art, Bitcoin, something which is not correlated to fiat cash flows, because everything else has been debased to the point that 1 million pages of information and strategy are all irrelevant. The models are all irrelevant. Everything you've learned in 30 years is all irrelevant. Best example, what are you going to buy in Venezuela or Zimbabwe if the currency collapses? It's going to work. And the answer is nothing. Nothing. If you're in Argentina and the peso slides from 3 pesos to the dollar to 150 pesos to the dollar, which is what happened in the last 10 years, there is no investment strategy, no money manager in Argentina, no portfolio of stocks, bonds, equity, derivatives, real estate, nothing which is going to work other than this one thing. You convert your pesos into dollars, you forward finance all your cash flows, you finance all your fixed assets, you issue as much equity as you can in pesos, you issue as much debt unsecured in pesos, convert it all to dollars, put it into a bank outside the control of the Argentine government so that they can't convert it back into pesos and debase it. And that's the only strategy. And what I've just described in a nutshell is the strategy of buying Bitcoin, right? Bitcoin's a bank in cyberspace. It's a hard asset. I take my money, I convert it to Bitcoin, I put it in a bank in cyberspace, and then I'm indifferent to how much currency gets printed by the Federal Reserve. And I've isolated my risk in that way.